You know what I want, boy? Do you know what I'm craving right now? I want some bussy, some delicious butt pussy. You know where I can find that? All I need to do is find a HIMS investor. That's right, HIMS and hers health. HIMS investors are going to be selling their butts, and they're just the clientele I need to satisfy my urges. Welcome back to Strongman Personal Finance. That's a joke. I'm not looking for any bussy right now. I'm actually a married man. Anyway, welcome back to my channel. My name is Christopher Bale. I'm a certified public accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon for $3. I may actually raise the prices though, so I can make more money off my fans. And not a big fan of HIMS stock. Now, where did I learn about HIMS? HIMS and hers. Well, two places, really. Number one, I used to watch this guy named George Perez. He's this freaking spastic doofus that pumps a bunch of random freaking hype stocks. And of course, he has like hundreds of thousands of subscribers, and he makes bank off of Patreon. But he mentioned HIMS, and then I was like, okay, maybe I'll look into it later. And then somebody commented on my channel recently, do HIMS, do HIMS. I was like, fine, I'll do HIMS. HIMS and hers. And I looked at it, and it's a total freaking bussy stock, okay? So let's go look and see what HIMS is all about. The first thing I want to look at, let's see if I'm sharing my screen, okay? First thing I want to look at is the ticker, HIMS, HIMS. It's currently trading at $7.14, and it is down 26% over the last 5 years. So this was a SPAC, I believe, and it started trading September 9th, 2019. And then I believe it merged with HIMS. HIMS was brought public around the end of last year. That's why this freaking massive spike happened when HIMS actually went public. Everybody, oh my God, oh my God, oh my God, oh my God. And then, of course, it dumped right after that. Massive pump and dump. So HIMS and hers operates a telehealth consultation platform. It connects consumers to healthcare professionals, enabling them to access medical care for mental health, sexual health. Can we say that? Or am I going to get banned for that? Dermatology and primary care. Is headquartered in San Francisco. The listed name is HIMS. Okay. So pretty small operation, $1.4 billion market cap. No PE ratio because it's not profitable. No dividend, which I don't really care. I don't like dividends anyway. So that's HIMS. It's basically another one of the disruptive telehealth stocks that, has tons of competition. We can read a little bit more. So this is the website. This is forhims.com/about. Handsome, healthy you. I am handsome. Thank you. HIMS is about personal wellness. You should look and feel your best all the time. Yeah, go to the freaking gym. Take a shower. You don't need this crap. Our job is to make that easy and affordable. We hope to enable a conversation that's currently closeted. Am I in the closet? Men aren't supposed to care for themselves. Who said that? We call BS. Man, HIMS is solving the self-care problem for men. You know what you need to do, boys? Go to the freaking gym, shave your face, wash your butt. Don't look like me in the morning. And the girls will just love you, okay? The people who depend on you and care about you want you to want you to. To do the most good, you must be well. Thanks to HIMS, men now have easier, more affordable access to prescriptions, products, and medical advice than they need, especially about the things they find hard to talk about. All right, so basically, I will say it is pretty convenient because basically we can read about how the process works, but basically you can just go on here and you get an appointment scheduled real quick, and then you get a prescription from a licensed medical professional, and then boom, you're good. You don't have to go to the doctors, blah, 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 blah. So I'm not against telemedicine, but I'm kind of against this company, number one, because it's massively unprofitable. And number two, I don't think it has much of a moat. I think there's massive competition. So here's how it works. If you're curious about using HIMS, okay, if you're clicking around asking yourself, what is telemedicine anyways, then you've come to the right place. Here's what happens behind the virtual curtain. Ooh, what's going on behind the curtain? Create your profile, enter your medical history and symptoms, okay? Speak with a healthcare provider, okay? Is this like the only guy? Free delivery. Get your treatment shipped to your door. Okay, that's pretty cool. So if I need some, ED medicine, I don't need that, guys. If I need some ED medicine, I can just go on here and, yeah. So here's some of the categories and stuff they sell. Ooh, it's the S word. Erectile dysfunction, premature ejaculation. Can I say this stuff? This YouTube's gonna be, or this channel's gonna be demonetized. Herpes. I need some of that, maybe. Sexual health, condom and lube kit. Then we have hair. Okay, so it's very man focused, very manly. Hair power pack. Blah 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 blah. So basically, it's treating hair loss and hair care. Skin, explore, anti-aging. Work out and get a lot of rest and don't drink a lot and use moisturizer you can get from Walmart. Skincare, fragrance, acne, mental health. Let's see. Wow. So basically it's kind of a one-stop shop for like men's wellness and health. I mean, like I said, I'm not against the concept. There we go. Sleep, melatonin. I take melatonin. It's good stuff. I get it from Walmart. And primary care. Yeast infections, ear infections. Wow, this is pretty cool. Now, let's see what's popular for erectile dysfunction. Get ED meds online, shipped to you. 90% cheaper. So I don't think they accept health insurance. Like to actually meet with a doctor, I'm pretty sure you don't. You can't have that covered under health insurance, but maybe the prescription might. You'd actually have to like really talk to them about it. But I think that's how it works. So, okay. ED. Now, let's look at some of the risks of this company. I pulled up their financial report. And then we're going to go look at the numbers, okay? I'm going to tell you why I don't like this stock. I hope you have a good feeling of what the company is. Telemedicine focused on men. Let's look at some of the risk factors. I know it's boring. It'll be really quick. Be patient. Okay, we'll see some pretty colors very soon, ladies and gentlemen. Be very patient. Summary of principal risk factors. Our limited operating history and evolving business makes it difficult to evaluate our current business and future prospects. That's right. That's right. Here's one that's funny. We identified a material weakness in our internal control over financial reporting. What that means is their accountants suck and they basically lost control over, properly reporting stuff on their financial statements. So you can trust this company to give you good numbers on their financial statements. Not. We operate in a highly competitive markets, and face competition from large, well-established healthcare providers and more traditional retailers. Wow. No moat and unprofitable. And they can't even report their financials correctly. Really leaning towards the stock, ladies and gentlemen. Let's see. Our pharmacy business will be subject to regulations in addition to those we face with the core telehealth business. So I actually think that's kind of a big deal. It's always, when it comes to like stuff like healthcare and, these new telemedicine companies, I think regulation, the risk of the government coming in and cracking down for whatever reason, I don't know why, but that's always a big risk. So yeah, basically they suck at financial reporting. They're in a highly competitive market with no moat, and there's always a risk of regulation. Okay, let's go look at some of the numbers. So I actually downloaded this. Ignore my hair, it's a disaster. Woo! I downloaded some of the numbers from Edgar, which is, Securities and Exchange Commission. And I actually did some analysis. Okay. Look at the pretty colors. So this is their income statements this is their latest quarterly report. So right here on column C, we have their earnings for the last 3 months ended September 30th, 2021. And then we have a comparison to the same time period last year. Over here, we have earnings over the last 9 months, ended September 30th, 2021. So their most recent earnings. And then we have a comparison to 2020. Now I have these different colored bars, vertical analysis and horizontal analysis. Those are the two main ways you can look at financial statements. Vertical analysis tells you, based on the income statement, the percentage of expenses or revenues as a percentage of revenues. So for example, if you want to know how much they're spending on marketing expenses and what percentage of their revenue is going into marketing, you can actually do that. So I just took the marketing expenses divided by the revenue, which they're spending a crap ton of money. Oh, God. On marketing expenses. All right. Same thing with general administrative. So that basically tells you your percentage for everything as a percentage of revenues. Horizontal analysis is comparing year to year. So vertical is for the current year. Horizontal is comparing year to year. How fast did their revenue grow? How fast did their cost of revenue grow? How much more are they spending on marketing expenses? There's so much you can look at with this stuff, okay? So let's do the most recent breakdown. The last 3 months ended September 30th, 2021. So if you didn't know this, revenue is 100% of revenue. It's pretty crazy, huh? Their cost of revenue is 26% of revenue, and their gross profit is actually extremely freaking high. It's 73, almost 74%. That's a very high gross margin. So this company, I think this company will be profitable in the future, but that's not my main beef with it. So very high gross profit. And let's look at their operating expenses. So they're spending 51% of their revenues, not their earnings, their revenues on marketing, which makes sense because they're a new growing company. And of course, they spent 60% almost of their revenues, so 44 million out of 74 million on selling general and administrative expenses. So that right there adds up to more than 100%. That's 111% of their revenues. So they had a loss from operations of negative 37% over the last 3 months, which is fine. Okay, they're a growing business, but it's just too young and speculative and no modi for me. All right. Going down, change in fair value of liabilities. So it looks like they recorded that as a revenue. So I guess the fair value of their liabilities went down. They owe less money. That contributed 11% to their margins. All right. And then they had total other income. So they're generating income some other way, 11%. Well, I guess that's from the liabilities. And then they had a loss before income taxes of negative 25%. So in reality, their true loss, their true margin is about 37%, negative 37%, because this change in fair value of liabilities, this is probably a one-time, one-off thing. This isn't going to be something that's happening every freaking quarter or year. So really, they're losing 37%, which is pretty freaking crazy, okay? That's because they're marketing like nuts, freaking nuts. And their net loss after factoring in the change in fair value of liabilities is negative 21%. Now, another thing I noticed, actually, we'll get to that in the horizontal portion, but they're diluting the crap out of their shareholders. So they had a loss per share of 8 cents. So for every share you get, you lose 8 cents a quarter. Horizontal analysis. All right, we're in column E right now. Let's zoom in just a tad more. So their revenues year over year increased 79%. That's pretty fast growth. That's why all these clowns on YouTube like revenue. So their revenue grew by 79%, but their cost of revenue grew by 92%. So their cost of revenue are growing faster than their revenues, at least year over year, okay? Marketing increased by 153%. Selling general administrative expenses increased by 126%. Oh, and their loss from operations increased. So their loss increased by 732%. Wow. So we also have this change in fair value of liability. So it looks like they actually lost money on the accrual basis of accounting based on the change in fair value of liabilities. Other income, massive increase, but really insignificant. And net loss. So their net loss has grown by 171%. Wow. That's pretty ridiculous. Now, here's the funniest thing right here. So on line 40, we have basic and diluted weighted average shares outstanding. So weighted average shares outstanding, it kind of tells you how many shares they have outstanding throughout the year, but if shares are issued in the middle of the year, they're not counted as a full share for the full year. That's what the weighted average means. But if you don't understand that, it's fine. Okay. It's like accounting, but I mean, just think this is the number of shares. So looking here, shares were 35 million as of 2020, September 30th. And now there's 200 million shares. That is an increase of 461%. Pretty redonkulous, huh? So that's the comparison for the 3 months ended September 30th, 2021. If we look at the 9 months ended September 30th, 2021, we can see that their net loss was 40%, 40.8%. So they're actually improving their losses, okay? They're slowly improving their losses, but Jesus Christ. That's pretty ridiculous. Actually, no. Hold on a minute. So for the 9 months ended 2020, they actually had a loss of negative 12%, and then they had a negative 40% loss in 2021. So their losses are getting worse. Okay. That's not very encouraging. That's what happens with a new company. They freaking lose money like crazy. So, I mean, I guess I could upload this, but then again, I don't want you clowns using this, and then you buy the stock, and then I get sued. So I'm not going to upload this. Sorry. Let me save this. And of course, I did a quick check of the statement of cash flows. So we have net cash used in operating activities. Negative, of course. Negative 31 million burned in the last 9 months. And last year they burned 2 million. Or was that? Yeah. Yeah, they burned $31 million over 9 months. And then last year they burned 2.2 million. Their free cash flow is negative 31.586 million. And it's negative 16% free cash flow as a percentage of revenue. So massive freaking losses, okay? So too early, too speculative, no moat, highly competitive industry, pumped by a bunch of clown YouTubers, talks about ED, and yeah, that's it. Let's see if there's any comments. Hi from UK. What's up, bro? Not going to Livestrong, man. I started using my wife's face lotions. I've noticed a difference. Yeah, I moisturize my face. I just use like Walmart crap. Makes me look sexier. Okay. You should take care of your skin, boys. That doesn't mean you have to buy freaking HIMS, their products. You need to meet Kevin's stock called Cloudflare. It's sales. Ooh, yeah, I need to check that out. I wonder if he recently talked about that. Herpes and boner pills. That's lovely, strong. Any chance of? Yes, I will get. Is that Charge Point? What is that? Let me see what that is. CP Charge Point. Yes, I'll do Charge Point. Okay, well, that's it. There's no further questions. I'm going to close this video down. Y'all have a wonderful day. Cheers.